All right, let's dive into one of the most important skills you can have in business, making a journal entry. I know, it might sound a little formal or complicated, but honestly, it's just your company's financial diary. And by the end of our chat today, you're going to see exactly how getting this one thing right can bring some serious clarity to your finances.
You know, if you're running a business, I'm willing to bet you've asked yourself this exact question. Maybe at the end of the month, you're looking at your bank account, just wondering, where did it all go? It's that feeling, right? You know money was moving, but the details are just foggy. Well, the answer to that very stressful question starts right here with the journal entry.
So the solution is what accountants call the journal. Sometimes you'll hear it called the book of original entry. All that means is it's the very first place that every single financial event in your business gets written down. And here's the key. It's done chronologically, as it happens. This simple process is what turns that mystery into a clear, running record of everything.
Here's probably the best way to think about it. Imagine your chart of accounts, with all its labels for assets, expenses, and income, is like a perfectly organized financial filing cabinet. Well, if that's the cabinet, then the journal is your daily logbook. It tells the story of how and when every single piece of paper actually ended up in those filing cabinet drawers. The whole point of keeping this daily logbook is just refreshingly simple. It's all about capturing the vital details of every transaction, the who, what, when, and why, before they just get lost in the day-to-day chaos of actually running your business. Now, the great news is you don't have to reinvent the wheel here. Not at all. Professionals follow a really simple, repeatable, four-step process to make sure every single entry is perfect. So let's break that down. This is the cycle for everything, okay? First, you identify the transaction. You look at a receipt or an invoice. Second, you analyze it. You figure out which two, or maybe more, accounts are affected. Third, you apply the rules of debits and credits. This just shows where the value came from and where it went. And finally, step 4, you record the entry. That's it. That's the exact same process for every transaction, big or small.
Okay, listen up, because this is the single most important rule in all of bookkeeping. It is the law of gravity for your finances. For every single transaction, the total of your debits must equal the total of your credits. No exceptions, no rounding, always. This perfect balance is what keeps the entire system honest and accurate.
And please do not let the words debit and credit freak you out. Seriously. Forget everything you think they mean from your bank statement. In accounting, just think of them as left and right. That's it. A debit, which you'll see written as DR, is just an entry on the left side. A credit, or CR, is an entry on the right side. So that golden rule is just saying the left side always has to equal the right side. Simple as that.
So a truly professional entry always has 4 key ingredients. You've got the date the transaction happened, you need the account names, and just by tradition, the account getting the debit is always listed first. Then, of course, you have the dollar amounts, and finally, a short note. We call it a narration, just explaining what happened. And trust me, that little note is going to be an absolute lifesaver 6 months from now when you're trying to remember what that purchase was for.
Okay, that's enough theory. It's time to put this into practice. Let's walk through a super common, everyday example to see exactly how all these pieces fit together.
Okay, so here's our scenario. Let's pretend it's April 14th. You just ran to the store and bought $500 worth of office supplies. Paper, toner, bunch of pens, the whole shebang. And you paid for it with cash, right out of the business's cash box. Super common, right?
This is what that transaction looks like as a perfect journal entry. Look, on April 14th, we debit our office supplies account for $500. Why? Because as a rule, expense accounts always go up with a debit. At the very same time, we credit our cash account for $500. Why? Because asset accounts, like cash, go down with a credit. See? The left side equals the right, it's perfectly balanced. Then we just add that short narration at the bottom, and boom, the entry is done.
So you might be sitting there thinking, okay, but does the date really matter that much? And the answer is yes, absolutely. Recording your transactions in chronological order isn't just about being neat and tidy. It's actually critical for the integrity of your whole financial story.
Doing things in order gives you 2 huge advantages. First, it creates an audit trail. That means if some number looks weird 3 months from now, you can easily trace it right back to the exact receipt it came from. Second, it ensures accuracy. It's your best defense against forgetting an expense or, even worse, accidentally recording income twice. It basically forces you to tell your financial story exactly the way it happened, step by step.
So let's bring it all home. What's the big takeaway here? What is the one idea that you really want to lock in from all of this?
It's this right here. This is the key. A journal entry is a snapshot of a moment in time. Think about that. Each little entry is just one small, precise building block. And when you get these daily snapshots right, one after another, the big picture, your income statement, your balance sheet, it all comes together so accurately, it feels like it's writing itself at the end of the year.
So, I'll leave you with this thought. Every single journal entry you make is another sentence in your company's financial story. And the question you have to ask yourself is, are you telling that story correctly? Are you capturing every single detail so that when you get to the final chapter, it all makes perfect sense? After today, you've got the tools to make sure that the answer to that question is always yes.